So in the latest economic commentary, we note that the Scottish economy continues to grow at a reasonable rate from the recovery. One problem is that the economy slowed in the first part of the year, and this conditions our forecasts for this year and next year. But overall, we still think that the recovery, if slow, is on track. We see jobs being created, outputs are still rising. Slight blip as unemployment rose recently, but the prognosis for unemployment is that it will still continue to fall. So overall, it's a fairly healthy picture in terms of where the economy is at the moment, and with growth round about 2.5%, that puts the economy above its long-term trend. However, as usual, there are positive influences fueling the recovery, and there are negative threats which we must always be aware, which could damage the recovery and also frustrate our forecasts. On the positive side, we do see that we're experiencing a period of low inflation, but we're not into the area of deflation. Low inflation is good for the economy because it allows real incomes to be higher than they otherwise would be, and that leads to more spending than they otherwise would be. And so that's good. That's helping boost household income. And therefore household spending. We're also seeing in the Scottish statistics a big boost to growth from investment, and that's again helpful. However, once you look beneath the figures, you see that this is largely been driven by government investment in structures, and particularly infrastructure, with the new Forth Road Bridge being invested in, and also the motorway network. What is a little concerning is that underneath that, business investment is still fairly weak, and that suggests that their expectations of future demand are not that robust. So these are the positive influences. The second positive influence is also the recovery in Europe. Despite the problems in the Eurozone, growth is starting to pick up there. The US economy had a bit of a blip in the first part of the year, but again seems to be getting back on track again. And world trade, the latest data on that suggests that it's also picking up even further. So these are good things, and all suggest that that would help the recovery to sustain itself over several years. However, to be set against that are the clear threats to the recovery. And the first of these comes from the growth continuing, despite the investment boost, to be fairly unbalanced. We see our imports in Scotland have increased more strongly than in exports again, so that means that net trade, the balance between the two, is dragging growth back. We also see that household spending, while driving growth principally, despite the boost to real incomes from low inflation, is largely being boosted by borrowing. And that is concerning because it's quite clear that household debt is rising to levels that were seen prior to the crash in 2008. And so our view is that unless we get picking up in exports and investment, this cannot really be sustained too much longer. Although we've been wrong on this in the past, and it may continue for longer than we anticipate. Secondly, of course, everyone is aware that the election victory by the Conservatives in May, last May, this will, unfortunately, from the point of view of the macroeconomy, if their plans to continue and perhaps strengthen austerity are actually put into place with the Chancellor's budget on the 8th of July, then that will reduce household incomes in Britain and reduce spending and act as a drag on growth. And will do so more if the austerity is focused on cutting spending, and particularly welfare spending, where the recipients spend all that they get, whereas if tax rises, people adjust their savings or may spend less from a given change in income. So the threat of a further austerity is a cautionary tale from the point of view of the recovery. And finally, we see that the Greek economy is potentially on the brink of leaving the euro. It may happen, it may not happen. There's significant uncertainty about what the outcome will be. The negotiations have not been concluded yet. There's a strong risk of a Greek default. There's a strong risk that that might see an exodus of funds from the Greek banking system and the threat of contagion in other parts of the Eurozone, which would in the end knock onto the Scottish economy through reduced export demand, impact on our banks who are lent to the Greek economy, and is something that we hope does not happen. So balancing all these two forces together, we're slightly adjusting our forecast downwards, only slightly this year to 2.5% from 2.6%. We're also reducing our forecast next year from 2.4 to 2.3%. We're forecasting GDP now for 2017, and we're expecting the continuation of that growth in 2016 into 2017. Jobs are continue to be created, around about 50,000 a year. The jobs market has done exceptionally well in this slow recovery, particularly in the rest of the United Kingdom, but also in Scotland too, and we expect that to continue. And that knocks into the unemployment rate. The unemployment rate is currently 5.9%. We expect it to fall to just above 5% by the end of the year. Next year, the end of next year, we think it'll be down to 4.5%, and then by the end of 2017, about just under 4%, say 3.9%, which is an interesting figure because it means that by the end of 2017, if that forecast is realised, Scottish unemployment will have reached where it was in early 2008 when the Great Crash happened, 9 long years after that traumatic event.